Be fearful when others are greedy, and greedy when others are fearful. And it sounds pretty straightforward. But what's the deeper meaning behind that?
Well, it's really the core idea of value investing, right? And that is basically finding assets that are trading below their actual worth. And so when the market crashes, people panic, fear takes over, they start selling off their stocks, drives prices down even further below what those companies are really worth. And that's where Buffett sees, a big opportunity.
So you're saying when everyone else is heading for the exits, that's when you should be buying.
Yeah.
It seems counterintuitive.
It feels wrong, doesn't it? But Buffett, he understands that markets are driven a lot by emotion, right? Not just logic. And when emotions are high, prices can get really disconnected from what a company is actually worth. And that's why you want to be greedy when everyone else is fearful and vice versa.
Thinking back to 2008, it really felt like the world was ending.
It did.
And, looking back, I think it's a good reminder of how much our emotions can just cloud our judgment.
Absolutely. And even during that crisis, Buffett stayed so calm.
He always does.
And he saw the opportunity in all that chaos, right? History shows us the market recovers, right? It almost always reaches new highs.
Yeah.
And this really underscores another big principle of Buffett's. Time is on your side.
Yeah, he always seems to be playing the long game.
Yeah, the long game, exactly. So he's not interested in making a quick buck, right? He invests for decades. And he views these crashes as temporary blips in the long-term upward trend of the market. Mm-hmm. So instead of, panicking and selling at the bottom, he just rides it out knowing that eventually, the market will recover.
It sounds like having the right playbook is one thing. But Buffett's real edge is his mindset, right? He doesn't just follow rules. He stays incredibly disciplined and rational, even when everyone else is losing their mind.
That's a huge part of his success, that emotional control.
Yeah.
Right? He doesn't get swept up in the panic like everyone else. He sticks to his principles.
So we know what his mindset's like. What about his playbook? What does he actually do during a crash? How does he actually put these principles into action?
Well, one of the key things he does is keep a lot of cash on hand.
That's right. Cash is king.
Cash is king, right? That might seem counterintuitive, but having that cash allows him to buy up those undervalued assets when other people are being forced to sell. Yeah. It gives him this huge advantage, incredible buying power when everyone else is, running away.
Right. But isn't there a cost to holding all that cash? Doesn't he miss out on gains, when the market's going up?
Yeah, that's a good point.
Yeah.
It is a balancing act, but for Buffett, that security and flexibility of having all that cash outweighs the potential gains that he might miss out on.
Yeah.
So he sees it as dry powder, right ammunition, ready to be deployed when the right opportunity comes along.
So it's not just having the cash, it's knowing when to use it.
Exactly. And when those opportunities do appear, he's not just buying anything that looks cheap.
Right.
He's incredibly selective. It's all about quality over quantity.
Yeah.
He looks for businesses with strong fundamentals that have a competitive advantage, a proven track record, companies that can weather, any kind of economic storm.
So he doesn't want like a beat up car just because it's on sale. Yeah. He wants like a reliable vehicle that can handle anything.
Exactly. And lastly, he avoids trying to time the market. He thinks it's pretty much impossible to consistently predict when the market's going to go up and down.
Yeah.
So instead, he focuses on finding those great companies and just holding on to them.
That takes the pressure off, right? You don't have to try and guess the peaks and valleys.
Right. It allows you to just focus on, understanding the business you're investing in and trusting in its potential long term.
So let's go back to 2008 again, because that was a perfect example of Buffett putting all this into practice.
Yeah.
Right. Everyone was panicking, and he saw a great opportunity. He invested, $5 billion into Goldman Sachs?
Yeah.
Which a lot of people thought was super risky at the time, but it paid off big time.
Huge. And he also invested a lot into Bank of America, too.
Yeah.
So these were really bold moves that showed his belief in those institutions, even when things were really bad.
So the big takeaways here are, think long term, be greedy when others are fearful, focus on quality companies, and stay disciplined. But, like we've been talking about, the hardest part is really mastering that emotional side, especially during a crash.
For sure. We can't predict when the next one's going to happen, but we can control how we react to it. And by learning from Warren Buffett, you can actually see market downturns not as a disaster, but as a chance to grow.
So as we wrap up, think about your own investment approach and how you handle, market volatility. Mm-hmm. Where do you see yourself in all of this? What can